For more on how money managers have really stepped up their bearish bets against office landlords, let's bring in now Bloomberg's John Gittleson and the Chief of Real Estate Strategy Research at Cohen & Steers Capital Management, Rich Hill. And John, let me start with you. You're joining us from LA. You've written a lot about this, but let's just get really basic first here in terms of how we're seeing investors short real estate, office real estate. What are the different ways? I take it they're betting against the REITs specifically.
Well, they are betting against the REITs, the stock. They're going short on that. Short interest hit records last week for some of the big REITs like Boston Properties, Vornado, SL Green, Hudson Pacific. And then they're also shorting the CMBS with office exposure. CMBS are commercial mortgage-backed securities, and there is a derivative market where you can short those. They're betting that some of the bonds that finance these buildings are going to go bad.
All right, so Rich, let me bring you into this conversation now, because when you look at commercial real estate, there's a tendency, especially for folks who are based in New York, to fixate on the New York office rental market. And of course, that's not the entire commercial real estate market at all. It's just one portion of it.
Yeah, for sure. So I think one of the things that's maybe most misunderstood about commercial real estate is the $20 trillion market in the United States. Yeah, the four main food groups of office, retail, multifamily, and industrial get a lot of attention, but there's a whole host of different asset types out there. Data centers, cell towers, healthcare. A lot of these asset types are actually doing quite well and have really healthy fundamentals. We don't dispute that commercial real estate and office is facing some headwinds right now, but if you look at the totality of the commercial real estate sector, it does have a lot of different moving parts, and some of them are actually doing quite better than others.
Well, John, that brings up the question of why right now, because this is a story that's been in the works for 3 years now, and to see short interest really tick up right now, connect that to this moment.
Well, yeah, agreeing with Rich that it's not all real estate, but the real estate sector that's doing the worst now is offices. And you have a couple of factors. One is, obviously, interest rates have gone up a lot, so refinancing these buildings. Then, as you pointed out, the Castle return to office situation where basically occupancy is about half of what it was pre-pandemic. So, and then you've got a recession coming along, and you've got these banks that do provide a lot of financing for these buildings, some cases wobbling, and in fact last year the FDIC told banks to reduce their exposure to commercial real estate, specifically offices. So there's a lot of factors that are weighing against offices right now. A lot of people expected more workers to return to the office in the fourth quarter last year. It didn't happen. So now is kind of when the rubber's hitting the road.
The rubber's hitting the road, and to the fact that, banks were told to reduce their exposure. Where are we on that story? What does exposure look like at this moment?
Yeah, it's the right question to be asking. So when we think about the commercial real estate debt market, it's about $5.5 trillion market. That's spread out between a lot of different lenders. The banks, in particular, actually own only less than, call it 50% of the total outstanding commercial mortgages. And of that amount, so if we're just talking about 2023 maturities, only 16% of those total $5.5 trillion is coming due in 2023, and only 25% of that is office. So, look, yes, office is really facing a lot of headwinds right now, but I think if you start unpacking where the risks are, maybe they're a little bit more staggered than the market thinks they are. Now, I don't want to be puppy dogs and rainbows about this. There is a lot of things that we should talk about, but it's maybe a little bit more spread out than maybe the market's perceiving right now.
It's a little more spread out than the market's perceiving. It's also geographically spread out, because certainly while it's a struggle to get people back to work in New York, it's not necessarily the case in other parts around the country like the Sun Belt. And this is something that you've pointed out in the past that people tend to misunderstand. Yeah,
look, we all live, work in New York City, but guess what? There's a lot of office and Sun Belt states that are actually doing quite well right now for a variety of different reasons. You've read all the headlines about people moving away from New York City to places like Tampa and Austin and Atlanta. That office is actually doing quite well, and the fundamentals are quite strong under a lot of different measures. So maybe I can just stop there, and I'm happy to elaborate.
Well, please.
Yeah, sure. So when you start to look at maybe the supply versus demand trends in these Sunbelt markets, they're actually holding up quite well. In New York City, yeah, they're decelerating. In Chicago, they're decelerating. In Los Angeles, they're decelerating. But we actually see a fair amount of strength in Sunbelt markets. So in many respects, we think the market's beginning to throw the baby out with the bathwater. Yeah, do you want to be very selective in these markets? Sure, you need to be. But I think it's really hard to paint the office market with a broad brush.
Yeah.
I think I can simultaneously say I'm pretty cautious on New York City office. Cohen & Steers doesn't have any exposure to any coastal office REITs. But hey, I think in some of the other pockets of money that we might run, it's a little bit more attractive to be looking at the office sector and the private markets and these select markets and select pockets of these markets.
And of course, John, bringing you back into this conversation, you're based in LA, where we've seen a couple of landlords strategically default on some loans given the outlook for their sector. Tell us a little bit about what they're hoping to accomplish there.
Well, by defaulting, they can reopen negotiations for a loan modification. In most cases, lenders, they want to get their money back. They don't want to have to manage the property. So they are saying, okay, let's negotiate. Maybe we can stretch out this loan. The old extend and pretend situation might be reasserting itself. I think what Rich was saying, though, is very instructive. You know, real estate is all like location, location, location. And the other thing is timing, timing, timing. If you can control the timing and, you know, pick your spots in the best time, you know, maybe you'll catch the stocks going down and get out of it before they rebound. Maybe you'll catch the, you know, specific bonds that are defaulting. But you do have to do a rifle shot, not a shotgun, to get this market.
Okay, so timing and location, two really big variables to try to wrap your mind around. Let's talk about location, because the story that you wrote recently on the fact that you've seen short interest go up pretty dramatically in the iShares US Real Estate ETF, that isn't necessarily targeted to one region of the country. It's a pretty broad brushstrokes sort of ETF. So you think about that risk. I mean, how do you think investors are approaching that when they're actually shorting some of these products?
Well, I think that's a good question for Rich, because he has broad exposure to the market. If you look at that ETF, some of the biggest names in it are Prologis, which is a, you know, industrial warehouse REIT that's doing great. American Tower, which is cell phone towers. There are apartment REITs in there. The biggest one, the last time I checked, was Boston Properties, which is actually doing better than some of the other REITs because they have a lot of life science office exposure. So yeah, you got to be careful what you're shorting when, not just location, but really look under the hood at these products to make sure that, oh, not all real estate is failing right now, as Rich pointed out very eloquently.
Rich, so is the lesson here to avoid ETFs that kind of lump all these different companies together and lump different locations together, thereby depriving you of the opportunity to pick and choose based on location and based on timing?
Yeah, I think that's a really insightful point. When we think about REITs, they have less than 30% leverage, less than 30% loan to values in aggregate. That's a pretty safe asset, especially given that their maturity schedules are well laddered over the next, call it 3 to 5 years or so. So I think there's a misconception that these are highly levered asset classes. They're just not. But look, let's be clear. Commercial real estate is at sort of the center of this debate right now. It is a levered asset class, and I think what the market's concerned about is the amount of equity borrowers might have to put in to refinance these loans in the future. If your property is down 30%, the lender is going to want you to put in 30% more equity just to keep your LTV constant, let's say 50%. But I think there's two important points I would make here. In aggregate, I actually think the commercial real estate industry is underlevered. Multifamily and industrial have done quite well over the past 10 years. Their effective LTVs, after adjusting for property price appreciation, have actually come down. So I think John's made some really good points about office. In aggregate, we think there's about 25 to 40% more equity that has to be put into them to refinance. So a cash-in refi, if you will. That shouldn't surprise really anyone. Green Street, which is a major advisory firm, says office valuations are down 30% right now. The REIT market's saying they're down that much. So it's very reasonable to expect that borrowers that own office are going to have to put more equity in. And the question becomes, do they have that equity? And what is the opportunity cost for them using that new dollar to refinance a property versus using that dollar on something else? else, like buying stocks, buying bonds, buying another property at wider cap rates.
Well, John, as we've established, obviously location is very important to this conversation, whether you're talking about the coasts or the middle of the country. But when it comes to office valuations, to the idea that they're down 30% or so, are we entering a new regime? Will we ever see those valuations come back? Or if you have half the workforce working from home for the foreseeable future, is that where they should stay?
Yeah, over 100 years, I'm probably not willing to make that bet. I think they probably will be back. But over the near term, look, we're dealing with a reset in financing costs. Financing costs are much higher than they were the decade prior. In fact, financing costs are normalizing back to where they've been decades and decades and decades, for decades and decades and decades. The last 10 years was sort of the abnormal state. So when you have financing costs higher, you have to have cap rates, so the return on buying a property, higher as well. You can't have financing costs at 6.5%, and properties trading below that. So I do think that we're starting to see, a real significant impairment in valuations. They're just resetting lower after a record run over the past 10 years, driven by record low interest rates.
What's the worst case scenario for commercial real estate?
Two things. Well, I think the worst case scenario is that the Fed has to keep raising interest rates to combat inflation, while lending conditions continue to tighten as the banking system comes under more pressure.
Basically what we had before SVB collapsed.
Yeah, look, it's if you want to tell me that the Fed has to raise interest rates, which is going to raise financing costs at a time that the amount of capital that you have is reduced, that's challenging. That would be the worst case scenario in my mind.